You're in college and you want to invest in stocks. Well, I've made millions of dollars investing in stocks myself since I graduated college, and I am here to help. It might seem overwhelming at first with all the information out there, but I'm basically going to cover everything you need to know in this one single video. I'll show you exactly how to invest in stocks as a college student, and by the end of the video, you'll know exactly what stocks are and how they work, why you need to invest now, the best platforms to use, so we'll talk about one that actually gives you a ton of free stocks when you sign up, how to pick winning stocks that actually make you money, how to invest like Warren Buffett, common mistakes, and I'll even take you through the process of buying stocks. So just a little bit about me. I'm 32 years old right now. I'm a multimillionaire and I love investing. If there's one regret I have, it is not starting earlier. And so yeah, if you're watching this video, props to you. You're already way ahead of me. But anyways, I'm really excited to give you this free course on investing in stocks. And I really do think that it's going to be more helpful than any college class you're taking. So let's get started. So topic number one is, why should you start investing in stocks right now? If you look at my channel, this is obviously something that I'm really passionate about. I've been investing for a long time. It's made me a lot of money, and I just think that everyone should start as soon as they can. So first, let's talk about growing your money early, right? Investing right now allows your money to grow over time. The more time you're in the market invested, the more money you will make. So if you buy a stock for, let's say, $10 right now, let's say it could grow to $15 after a few months or a few years. And then over time, that $15 could turn into $50, $100, or even more, right? Recently, we've seen with NVIDIA, that is a stock that has absolutely blown up. I think over half of people that actually work at NVIDIA that have stocks are multimillionaires. Not saying every stock does this, but there are stocks that grow like crazy. Now, the reason why it's important to get started super early is because you want to take advantage of compound interest. Now, what this basically means is, have you seen like those curves that basically go like this? Well, that's an exponential curve. And that's literally what happens when you buy and hold stocks for a long amount of time. Let's say you invest $10 and then that year it goes up 10%, right? So that's a 10% gain, meaning you have $11 after the first year. Let's say you hold that 10% gain for the following year. So 10% on $11 means that you're growing it to $12.10, which is a gain of $1.10 versus $1 the year before. Now, if you just keep doing this, you'll see that every single year, even if you don't put any more money in, that money is going to grow faster and faster. It makes $1 the first year, $1.10 the second year. It'll grow $1.21 the following year, and every single year you let that money sit and compound, every year it goes up. And so basically that's what we want to do. That's why we want to start super early. That's why you are watching this video right now. And I guarantee you, if you start investing after watching this video, it's going to change your life. And yeah, it's just such a good habit to have, right? So I encourage you guys to learn how to save, learn how to budget, and invest as early as you can. You don't need to invest that much right now, but it's more just about getting that habit down and staying consistent with it. If you have a goal to build your net worth throughout your life, then investing is going to be a huge component of that. You can't just make money and let it sit in your bank account, rotting away, because inflation is literally going to make your money worthless. You need to have it invested in assets, and stocks are one of the best assets historically that have performed extremely well. And every millionaire or billionaire you see, they're going to have a ton of stocks. And yeah, I just want to say I'm really proud of you guys for even caring about this. I know it can seem pretty boring. It's something that you don't really learn in school, but the fact that you care about it right now is a huge advantage. And so I just encourage you to take action. All right, so let's do an introduction to stocks. Firstly, what are stocks? A stock is basically a piece that represents ownership of a fraction of a company that's selling the stock. I know that sounds a little bit complicated, but hear me out. So let's say a company has 1,000 shares in total and you own 100 shares of that. That means you own 10% of the company, right? You can think of each of these shares as a tiny fraction of an overall company, and having these shares actually gives you, part ownership in that company. So technically, yeah, if you have Apple stock, you own a portion of Apple. If you have Tesla stock, you own a portion of Tesla. The reason why companies have stocks is because they want to raise money for their business operation. That's basically why companies go public, because they can issue a stock, they can trade it on the open market, and that can raise money for these operations. Now, there are two different ways to make money from stocks. So there's dividend income and there is capital appreciation. So let's talk about what those are. So dividends, this is basically money that a company gives out to stockholders for holding the stock. It's basically a reward saying, hey, we appreciate you for investing in our company, for basically putting your trust into us. Here is a reward, a payout from our profits for the year. These dividends are typically paid out monthly, quarterly, semi-annually, or annually. And this is just going to depend on that certain stock. Let's say you have a stock that is worth $20 and then pays an annual dividend of $1. This basically means that the dividend yield is 5%. And the way that you get this is by taking the dividend and then dividing it by the price. So if you own that $20 stock, and every single year you get $1, you can see that, if it stays the same, after 20 years, you'll make that whole $20 back. And so, for example, let's take a look at Apple. This is a very popular company. It's done extremely well. I actually have a big portion of my stocks in Apple, and currently they pay out 0.41% dividend yield. You might be thinking that doesn't sound like a lot, but that's actually okay. Even if a company doesn't pay out that much in dividends, it means that they are likely more growth oriented. They want to reinvest back into their own growth, and that's totally okay. A lot of the times these stocks with low dividend yields, they're continually reinvesting themselves, and so they're actually able to grow their company faster, and as a result the price of these shares actually goes up. So that's when you can actually make capital appreciation, which we will talk about. But yeah, going back to Apple, so this 0.41% dividend yield, if you look at the current price of Apple, which is about $243 per share, this basically means that you earn about 99 cents annually. So yeah, doesn't seem like a lot, but it's just a added benefit of holding stocks. A lot of people, they don't own stocks just for the dividend yield. They sort of view it as a cherry on top, an added bonus. And yeah, I know personally, I haven't made that much from Apple with dividends, but I've made a lot more from the capital appreciation. So let's talk a little bit more about what capital appreciation is. It's essentially a rise in the stock's market price, the price that the stock is trading for on the open market. So for example, let's say you buy a stock for $50 and then it grows to $70. That means you made $20 in capital appreciation, right? 70 minus 50 equals 20. That's the net profit. And that $20 becomes a capital gain and is taxed as such. If, for example, you bought the stock for $50 and sold it for $70 within the span of a year or less, that is going to be considered short-term capital gains. And these tax rates are actually higher. It's essentially taxed as ordinary income. Now, let's say that you actually buy that stock for $50, you sell it for $70 after 1 year. So let's say 380 days. In this case, your tax rate is actually going to be lower just for holding it over 1 year. That's why a lot of people, they don't like to, hold stocks for a short period of time. They'd rather hold it for longer so that they can take advantage of long-term capital gains and pay a lower tax rate. That's essentially what I like to do. I don't like to trade stocks. I don't like to get in and out of them really fast. This creates a mess for your accountant when figuring out how much money you make. And of course, you're paying a higher tax rate. So I usually will just hold on to stocks for well over 1 year. I'd say that for most people that invest in stocks, capital appreciation is where they make the bulk of their money. Some people consider themselves dividend investors. These are people that, prioritize the dividend. They look for companies that pay a high dividend yield. And yeah, there are companies that pay 4, 5, 6% or more dividend yield. However, the stock price of those companies usually is pretty flat, so they're not making that much money from capital appreciation. But it is a good way to basically guarantee that you have some cash flow coming in every single dividend period. Okay, let's talk about a few more terms that I think are extremely important. And bear with me, I know this can get a little bit tiring, but I think these are very important terms. Market cap is essentially the total value of a company's outstanding shares. Let's say there's 1,000 shares for this company A, and each share is worth $1. That means that the market cap for this entire company is $1,000. Now, a small cap company is going to likely have a market cap of below $2 billion. A mid cap company is going to have something between $2 and $10 billion market cap. And then a large cap like Tesla or Apple, that's going to be above $10 billion. Most of the companies that you know personally are going to be large cap. You might know some mid cap, and then you probably don't know any small cap companies. Earnings per share is also a very important term. So this is basically how much profit a company earns per share of its stock. So the formula is net income minus preferred dividends divided by number of shares outstanding. A little bit complicated, but essentially the higher the earnings per share, the better. But the most important thing is that you just want to look at the trend, the growth of the EPS. For example, companies with EPS growth rates above 10% annually are often strong performers. And then another term is PE ratio. This is the price to earnings ratio. Essentially shows how much investors are willing to pay for $1 of a company's earnings. The formula for PE ratio is the stock price divided by the earnings per share. And so obviously, if you have a very high PE ratio, that means that the stock price is actually quite high compared to the earnings per share. And a lot of tech companies like Tesla and Apple, they have a pretty high PE ratio. But across all companies, a PE ratio of between 15 to let's say 25 is considered average. Although some industries like tech tend to have much higher average PE ratios, while some industries have much lower PE ratios. Usually the more boring companies will have lower PE ratios, but essentially the way you read the PE ratio is if the ratio is, quite high, it could mean that it's overvalued, and a lower PE ratio could mean that it's undervalued. All right, so let's quickly go over some really important things that you should know. And these are things that I wish I knew earlier. It would have helped me a lot. So it's good that you are learning them right now. Before you invest, this is what matters. You should invest a small amount into safe stocks, consistently. If you're in college, it's likely that you don't have that much money, which is completely normal. You don't want to put all your money into one stock, which I don't think that's the safe way to do it. But when you take a small amount and put it into safe stocks consistently over time for the next 30, 40, 50 years, that is going to allow you to take advantage of compound interest and time invested into a stock. So the saying is basically, you don't want to time the stock market, you want time in the stock market. So these three lines show the impact of when you start. Let's say you put $200 into stocks per month at the age of 25 versus 35 versus 45. You can see that a 10-year difference on start time has a huge impact on the overall portfolio value. Of course, this is going to depend a little bit based on what returns you get. But yeah, it's just a visual that shows you how important it is to start investing right now. I'm going to say that multiple times throughout this video. I hope you don't get sick of it. It's just a very, very important concept. Another very important thing to know with stocks is that with any type of investment, yes, there is some risk, but you need to take risks in life. I'd say that stocks are actually not too risky for most people unless you are day trading or investing a bulk of your money into more dangerous stocks that could go up a lot or could go all the way down to zero. And yeah, I don't want to scare you, but there are companies out there that have gone completely to zero. They've gone bankrupt. They are, now worthless companies, and everyone that had money in those stocks lost all of their money. But if you invest into a wide range of companies that you yourself believe in, that you've done due diligence on, this essentially wipes out that possibility because there's no way that all these companies are going to go to zero. Rather, if the American economy keeps growing like it has for the last, X amount of years, then your stocks should go up as well. But this is all historical, you guys. The past does not predict the future, but historically, investing in stocks has been a great way to make money. If you want to learn more about investing, there are some really good books out there for you. This is a list of some of my favorite investing books. If you have some time, I encourage you guys to read them. It's going to cover a lot of the same stuff in this video, but it's going to have additional perspectives. And yeah, the more time you spend learning about a subject, the better. So I encourage you guys, if you have some time, check out these books. Okay, so now let's go over the step-by-step process of actually investing your money into stocks. Step number one is to basically set your investing goals and priorities. So before you start investing, you need to ask yourself, what are your current goals and what are your current priorities? Yeah, if you don't have any money set aside, that's totally okay. You don't need to start right now. And yeah, there might be more pressing matters. You might have high interest debts. You might have to pay for living expenses. But even if you have, let's say, $5 extra per month, I'd say put that money into stocks. It's a great habit to start forming right now. Defining your current money goals is great. So you want to think, am I saving for something in particular, like a college loan, a car, or travel? And then you also want to decide if you're saving for the short term or for long term. I also encourage you guys to try and build an emergency fund. This is very important. Generally good to have at least 3 to 6 months of living expenses in case of emergencies. Now, this is generally the rule once you graduate college and you're working a job. But if you're in college, maybe you don't have that much expenses, which is great. And that probably means you need less of an emergency fund. If you are building an emergency fund, I definitely don't think you should have your money in a normal checking account like most people. That money is just rotting away, not making any interest. I encourage you to put it into a high yield savings account. My favorite one is the SoFi one that I use. Right now it's paying about 4% interest, which is really good. And you can get up to $300 for opening an account if you guys use my link. So I will have that down below. Like I said earlier, if you have any really important bills, pay those off. So if you have any high interest debt, consider paying that off before you invest. And also you want to know your risk tolerance. So be honest about how much risk you're comfortable with. This is really going to guide the types of stocks you invest in. And I'd say that, yeah, younger investors, they can generally afford to take more risks with their investing. But yeah, I'm not that risky of a person when it comes to investing, so I tend to take a more conservative approach. Okay, step 2 is to figure out your investing strategy now that you know those things. I like to break down into 2 different types. So there's growth/active investing. So this is basically investors that want to be active in the market and take more risks. These are people that like to read about stocks on the daily. They really love certain companies. And yeah, these people will usually invest in fewer companies at a time, but be more invested in each one. Then there's dividend/passive investing. So this is more for long-term investors that want to be more passive, more safe, and sort of just build generational wealth without having to think about it too much. Now for me, I fall more into the passive investing category. I don't have that many dividend stocks, but when I do invest in stocks, I only do it if I plan on holding it for a long time. I don't get into a stock just to flip it after, let's say, 3 months when it sets off the short-term capital gains. And 2, it just takes up a lot of my mental bandwidth. I would rather invest my time and energy building my businesses, figuring out how to make more money rather than trying to time the market, get lucky on a few certain companies and stuff like that. And so just for me personally, I do think most people should take a more passive approach to investing. Because yeah, if you look at the data too, people that are more passive with their investing, they tend to actually do a lot better. If you trade stocks emotionally, then that's not the way to do it, right? The people that make the most amount of money in the stock market basically completely forget that they have a stock. Let's say a stock is $10, it goes up to $15, great, $5 return on each share. I think a lot of people might want to sell it then. What if that stock keeps going up? And this has been the case for many stocks. People that forget about a stock, they just leave it. They're like, okay, whoa, my money grew a lot. And they probably would not have held on to it for that long if they had seen those gains before. Now, if you want to get into active investing, it's very important to just do your own research, do your own due diligence. Don't buy a stock just because someone else said to buy it on the internet. And you want to really learn all the different key terms like ratios. You want to be able to look at financial statements, history, all that stuff. If you're in college, this is probably not the best way to start, like I said earlier, because it does take a lot of time and effort to learn. And it just seems to be that the people that are the most active when it comes to investing, they actually make the least amount of money. If you want to take a more passive approach to investing, you still need to do your research. You still need to do your due diligence. However, with passive investing, it's likely that you are in more companies at a time. You probably have more ETFs, mutual funds. We'll talk more about this later on. And so it's actually a lot safer to do less research. With this approach, the best things to do are basically dollar cost averaging into ETFs, index funds, mutual funds. These are basically a collection of a bunch of different companies. So you can literally buy a share of an ETF that basically models the S&P 500. And when you buy that one share of that ETF, you're essentially investing into 500 of the top companies in the US. And so as you can see, that's a way more diversified approach. The only way that ETF is going to go down is if the American economy as a whole goes down. And it's very unlikely that that is ever going to go to zero. ETFs have done extremely well for me over the last 4 or 5 years. And so I will say a ton of my money is in these index funds and ETFs. Now, dollar cost averaging, this basically means that you are putting a small amount into your investments every single month, year, whatever it is, for a long time. You're not putting all your money into stock at once. Rather, you're splitting it up and consistently putting it in over time. Okay, let's talk about Warren Buffett's investing style. So he really does focus on long-term value investing. And here's basically how you can take on this approach. One, you want to buy high quality companies. Essentially, Warren Buffett, he invested in Coca-Cola because of its strong brand and consistent demand. Think about any companies that you use on the daily that you really enjoy. And then two, you want to invest for the long term. Warren Buffett has held stocks for decades. And you want to think of your investments like planting a tree, right? You won't see results immediately, but with time, they can grow into something that's massive. You also want to stick to what you know. So he doesn't invest in companies or industries that he does not understand. If you love tech, research companies in those fields like Microsoft, Apple, whatever. If you don't know anything about tech, then maybe you shouldn't invest in those. And four, you want to be patient. So he often says the stock market is a device for transferring money from the impatient to the patient. So even if your stock dips in value in the short term, trust your research, trust your instincts, think about the potential in 5 or 10 years. I think these are really good lessons that are extremely important. And while it is boring, you'll find that boring investors are usually the ones that win. So it's not sexy advice. It's not gonna make you 10x your money in 5 days, but when done correctly over a long period of time, you're essentially guaranteed to become a millionaire. Okay, the next step is to decide on your budget. So figuring out how much money you can actually invest without hurting your day-to-day expenses, because yeah, you don't want to run out of money. You don't want to put money into investments you don't have money for it. Since you're likely just starting out, I encourage you to invest not too much money at the start. So let's say you have a part-time job that makes you $1,000 a month. If you can, consider investing like 10-20%. Everyone's situation is going to be different. Everyone has different expenses. So it's really up to you to decide how much money you want to put into stocks. There are so many different ways to budget as a college student. I'm not really going to talk about this, but I'd say that the most prevalent rule out there is the 50-30-20 rule. So essentially it says you want to put 50% for your needs. These are things that you need to actually live. So your rent, your food, transportation, 30% for wants. So these are things like dining out or entertainment, and then 20% for savings or investing. Again, every person's situation is going to be completely different. So I'm not really going to cover this, but just figure out your budget, prioritize it, talk about it, spend a few hours figuring it out, and you'll know how much you can actually invest. Okay, so step 4 is to actually open up a brokerage account. Now, there are tons of brokerages out there, but for most beginners, I just recommend using an easy one to use like Webull. Or if you're outside of the US, Interactive Brokers is also a great choice. You essentially just sign up, you link your bank account, and then you deposit your funds. After that, you can actually choose the stocks to invest in. Now, what specifically is a brokerage. It's basically a platform that allows you to buy, sell, and manage your investments, including stocks, ETFs, and mutual funds. So essentially, they're a middleman between you and the stock market. Most brokerages are extremely easy to open, such as Webull. There's no account minimums. You can also buy fractional shares. So let's say you don't want to invest $243 into Apple. Well, you can actually buy a fractional share. Say you want to put in $10. That's going to get you a portion of a stock. And then they also have tons and tons of educational tools. So they have news and different things to learn about investing. Now, like I said, for most of you guys, I just recommend using Webull. This is a brokerage app that I use all the time. I trade on my phone, I trade on my computer. And if you guys use my link down below, you're going to get a ton of free stocks just for signing up. This basically allows you to get started with no risk, right? It's not even your money. You're getting free money just for opening an account. So yeah, I'll have that link down below. Webull is great for beginners as well as even advanced traders. I think you'll find that their UI is really easy to use. And yeah, later on, I'll actually show you guys how to buy a stock in the Webull app. Another really great brokerage is Interactive Brokers. Webull is mostly just for the US. So if you're outside the US, then this could be a great choice. So after you open up your brokerage account, you basically need to fund your account with money. All you need to do is link your bank account to your brokerage account, and then you'll be able to pull money directly from your bank straight to your brokerage account. Once that money is in your brokerage account, you can use it to actually trade. Or if you want, you can actually buy stocks directly using the money in your bank account. So after that, of course, you need to actually buy stocks. And the point I want to really emphasize is you want to diversify your portfolio. This is the trading strategy that I use, that I truly believe in. It's the one that I'm passionate about, and it's literally what I do. I don't think it's a good idea to put all your money into one or a few stocks because that is quite risky. Essentially, the more you diversify, the less chance you have of losing money. For me, there's just not one or a few companies that I want to put all my net worth into. Rather, I believe more in the US economy as a whole. So that's why I invest in multiple companies. I have a ton of shares in individual companies, but have even more money in ETFs and index funds. So let's talk about some good stocks to consider. Some of the most popular stocks are going to be stocks like Apple, Microsoft, Coca-Cola. These are pretty stable and reliable companies with a long history of steady growth. Some of them have solid dividends, but all these types of stocks, they're more of a long-term play. It's not likely that they're going to go up a ton within 1 year, but if you hold them for a long time, historically, these have performed extremely well. You also have growth stocks. So these are companies that have a lot of potential and future expansion. Companies such as Tesla and Nvidia, right? With Tesla, they are really taking a huge bet on their tech. So this expanding market can be absolutely huge. That's why Tesla has such a big PE ratio. Same thing with Nvidia, right? With the rise of AI, there is so much growth potential for this company. And yeah, if you look at the last 5 years, these two companies have done extremely well, but they also have been more risky hold, right? Because if they don't actually meet the growth that everyone is expecting, then the price of them can actually fall quite fast. Personally, I think the best stock to consider is just going to be ETFs. So these are exchange traded funds. Some examples are going to be SPY, VUG, QQQ, VOO. And yeah, like I said, with these, when you buy one of them, you are essentially investing in hundreds of different companies. Okay, so I have my Webull account pulled up here. This is basically my watch list. So if there's any stocks that I'm interested in, I can actually add them here so I can see the status and prices really quickly. But let's say I want to invest in Apple. So I'll click on AAPL. That is the stock ticker. You can see that this stock is traded on the NASDAQ. You can see this is the current price as of right now when I'm filming. It's $248.13 for one share. The market cap is about $3.75 trillion. And here's the chart. So I can basically set this chart for 1 month, 3 months, 1 year. You can see that this company has done extremely well over the last 5 years. And on Webull, there is a ton of other information here. So you can see all the sales and the time that those sales took place. You probably don't need to have all this information, but it's there. So if you come here to news, there's tons of news about Apple as a company. This can give you a lot of information about the current outlook of the company, what they're doing. There's also an analysis section. So based on 47 analysts, they rate it as a buy. They have analyst price targets. We have a lot of interesting metrics to look at. They also do a technical analysis. So yeah, there's just a ton of information about Apple, and it's all going to help you do your own due diligence. Under the company tab, we can see the earnings information, the earnings per share. You can look at different key indicators, their income statement, balance sheet. And yeah, if you want to learn more about a company, this is a great place to do it. But let's say I want to actually buy a share of Apple. So what I'm going to do is come here to trade. I'll be able to select whether or not I want to buy or sell a share. So if I want to buy, it's of course buy. If I want to sell, I'll click on sell. So let's say I want to buy something and I'm going to set my order type. Now you're going to click on this and you'll see that there are different types of orders. Now, a limit order is a bit more complicated. Basically allows you to buy a share at a fixed price or lower. So let's say I set a limit price of $240. That means that it's only going to actually purchase it if the price dips down to $240. Now, it might never dip down to 240, right? So that means I would not buy the stock. That's why generally you want to set a limit order for pretty close to the current market price. Otherwise, it might not actually buy it, and then you might miss out on a ton of gains. For most of you guys watching this video, I would just suggest doing a market order. So you can see a market order is buying a security at the current market price. This is the easiest one. So I'll select that. Basically, that means that I'm going to buy at whatever the price is when the market opens, and I can set the number of shares I want to get. You can even do partial shares. Let's say 0.25. You're going to leave time in force as day, and then you're going to click on buy. It's going to confirm what account you're buying from. It's going to confirm the quantity, and it's going to confirm the price, which we just set as market price. After that, you basically click confirm, and it's going to execute the order. Same thing if you want to sell. So you just go to sell. You can do a market sale, which is the easiest. You set the amount you want to sell, and then you click on the sell button right here. But yeah, basically just get this app, get those free stocks with my link. And any company that stands out to you, you can just research everything you need to know on this app. It's really powerful, and it's just a great place for any beginner to start investing in stocks. So now let's go over some of the common mistakes and how to avoid them. Mistake number one is you invest without any research, and you're just buying because it's trending. Now, I've fallen into this trap myself. It's very, very easy to do. But with anything that has any element of risk in it, I'm going to tell you, you need to do your own research. Do not get into things blindly just because other people tell you to. Yeah, they can influence your decision to buy something, but you should always make sure yourself, because yeah, you're putting your own money into it. And I think that is quite important. To avoid this, you just basically use platforms like Webull to study the company before you buy something, read the news, and just make sure it's a company you believe in and want to hold your money in. Mistake number two is expecting to get rich quickly by just investing in high risk, high reward stocks. First of all, stock investing itself, unless you're day trading, is not going to get you rich quick. It's just not possible unless you get extremely, extremely lucky. And then when it comes to day trading, yes, you can make a lot of money, but it's also very likely that you're going to lose a lot of money. The thing with day trading, you guys, is that a lot of people, they'll make some money, they'll make a little money, they'll make a little money, but then they'll lose a ton of money all at once. And losing that money happens extremely, extremely fast. This is generally because they are leveraged on trades, and let's say the price movement is in the opposite direction that they want, then yeah, that's when they lose a ton of money. I've literally had friends lose hundreds of thousands of dollars within one day just because they were day trading. So I don't think that's something that you should do. Rather, just focus on the long term, focus on a more passive investing approach, and just let your money grow for you. Let your money work for you on the side. Mistake number three is panic selling when the price drops. So the thing with investing is that the markets are always going to be up and down. With more volatile stocks, the price can actually jump 5-10% in a single day or even more. And when you look at your account balance and you're like, oh my God, I just lost 10% in one single day, that induces a lot of people to react emotionally and sell their stocks. You basically just need to go into investing thinking, this is money that I'm just going to keep there. I'm not going to emotionally sell if something dips. I'm not going to emotionally sell if something just jumps a lot in one day. And just know that the markets go up and down a lot. We literally cannot predict any of these fluctuations. You cannot do it. Trust me. And I think knowing this helps a lot of people not panic sell if something happens. Mistake number four is sometimes people will use borrowed money to invest. For example, this can be money from student loans or credit card advances. You only want to invest money that you can afford to lose. So definitely don't do that. I don't think that's smart. And that's why you only want to invest if you have extra money that you don't need for your needs. We've already talked about why day trading is not ideal for beginners, but I think a lot of people, they are going to get tempted by day trading. They're going to see people post on social media with their flashy cars saying, I made this much money from day trading, but it's just a really good way to actually lose money really quick. Most people are just not built for day trading because they are emotional. Anyone without experience in day trading is likely going to lose money. And like I said earlier, short-term taxation is a lot higher than the long-term capital gains. So yeah, you could get hit with a ton of taxes. So I know this video is about investing in stocks, but there are some alternatives to invest your money into. And yeah, I don't think everything you have to invest should be put into stocks. Rather, it's also important to diversify the types of investments you put your money into. There's also things like real estate, bonds, cryptocurrency, having your money into a high yield savings account, which isn't really investing, but it's a safe place to store your money. And most importantly, it's going to be yourself. If you're in college, it's likely that you aren't going to get real estate, that's totally okay. Bonds can be a safe place to store your money for, pretty fixed returns. But yeah, let's talk about each of these in a little bit more detail. Real estate is probably something that you're going to invest in later on in your life. This can be your own primary home. This can be rental properties, investment properties. You can even own shares in real estate funds. There's also bonds and government-backed things. So personally, I have a lot of money in treasury bills right now. They currently pay in the high 4 to around 5% interest, and just a very safe place to store your money. The really good thing about treasury bills is that there is no state income tax on the money that you make. And being that I'm in California with extremely high tax rates, that can actually save me a good amount of money. There's also cryptocurrency, right? So as I'm filming this video, crypto is booming. We just hit $100,000 for Bitcoin. Ethereum is at like around $4,000 each. And yeah, if you believe in crypto as a currency, as a store of value, then yeah, you can also diversify and hold some crypto. I will say that crypto is definitely more high risk than stocks. It's more high risk than real estate, bonds, pretty much everything. And so you definitely do want to be careful with it. A small portion of my net worth is in crypto compared to everything else. The most important thing you can invest in by far, without a doubt, is going to be yourself. So this is going to be your education. This is going to be investing money into taking calculated risks. And yeah, basically think of yourself as a tool. Think of yourself as a sponge. A sponge without any water in it can't clean. There's literally no use for it, right? So I think investing money into yourself, this is going to pay the highest ROI of anything that you put your money into. And the more money and time you invest into yourself, into your knowledge, the higher capability you have of actually making a lot of money. So yeah, this is the most important thing. And if you want to ever start a business, I think that's a great way of investing in yourself. If you love reading books, that's a great way of investing in yourself. Yeah, super, super important. You're investing in yourself right now, which is great. And if you're taking your free time, which I'm sure you don't have that much of, to watch videos like this that are super boring, but pretty helpful when it comes to education, then yeah, you're already investing in yourself. So good job to you. Another thing I want to touch up on is a retirement stock accounts. So the government does have some pretty big incentives for opening certain types of investing accounts. So you've probably heard of a 401k, a Roth IRA, a traditional IRA. Let's sort of talk about these and why they are really good. So Roth and traditional IRAs, these are both individual retirement accounts. So it's money that you invest for retirement while enjoying tax advantages. Now, depending on the year that you're watching this video, there are going to be contribution limits. So you can't just put all your money into a Roth IRA, for example. As of 2024, if you're under the age of 50, you can put in $6,500 per year. And then if you're over 50, they allow you to actually put a little bit more, $7,500 per year. Now, the reason why retirement accounts can be really great is that it allows you to pay less in taxes. Being an American, you're going to pay a lot of taxes regardless. And so it's always nice when there are some things set up that we can save some money on in terms of taxes. With the Roth IRA, your investments are going to grow tax-free. And if you want to withdraw your contributions, you can actually do that without any penalties, but any of the money that you make, you can't withdraw that without penalties. The bad thing with a Roth IRA is that you can't reduce your taxable income in the year that you put money in. The good thing about this is that, let's say you put in $5,000 this year. Well, you're going to have an immediate tax savings through that $5,000 deduction on your total income, but the money that you actually make in this account is going to be taxed later on when you take it out. There's also a 401k, but I'm not really going to talk about that too much because with a 401k, you need to have some type of employer. Once you do get a job, if there is a 401k, I do recommend putting your money into it, especially if there is a 401k match from your company. All right, so let's go through my final thoughts. One is you want to start early, right? Small investments can grow significantly over a long period of time. The earlier you start, the more time works for you. And if you're not in college, if you're already a bit older, it's totally okay because the best time to invest is still today. It's not tomorrow. And even getting started right now is going to be a lot better than if you were to delay and get, started investing later on. You also want to learn by doing, right? Not every single investment you make is going to make you money. Some of them you're going to lose, and that's totally okay. I have lost on tons of investments. With investing, you will learn a lot just by actually doing it. So yeah, you can watch this video, but until you actually invest your money, that's when you actually learn. And so yeah, if you're just watching this right now and you have some free time, just use those links, open up your account, start investing with $5, $10, whatever it is. And that is really just the best way to learn. You also want to stay consistent, right? So make investing a habit, even if it is just $10 a month. And of course, you need to be patient. Patience is one of the most important words in the investing game. The stock market, it goes up, it goes down. But if you look at it in the long term, the stock market has done extremely well historically. Investing is not about making quick money. It's about building your net worth over time. Start small, keep learning, keep doing it, and your future self will thank you. But yeah, you're already crushing it. You are young, you're watching this video, but you're already interested in stocks. So I've said this before in this video, but I am proud of you for, taking the time out of your day to learn about investing. It is daunting. There is so much information. There's a lot of stuff that I didn't cover in this video, but I covered all the fundamentals that you need to know to get started. And I think that is just so important. I don't want to bombard you with everything that there is. This video would probably be like 30 hours long, but with the information we covered, you have a great foundation to actually get started. You have a good understanding of the basics. So I do think you are ready to start. I do want to say happy investing. I know this video was quite long, but hopefully you took some notes, or if you didn't, feel free to go back. We have chapter markers for all the different topics we talked about. So if there's anything that you want to rewatch, feel free, go back to that, learn it. And yeah, I hope this video can give you the confidence and information that you need or want to actually get started investing. I really wish I had started investing in my college days. I got started like right after I graduated. But yeah, just do it. If you guys have any questions, make sure to leave them down below. I'll try to answer some of them. Maybe some other viewers will answer them as well. And yeah, we're all in this together. I hope you guys can make some money, build your net worth with investing, and hopefully this video was helpful. If you got any value from the video, make sure to leave a like. That helps me a lot. Leave a comment, and also subscribe for more content just like this. I do a ton of videos about entrepreneurship and investing, and my whole goal is to help you live a financially successful life. Thank you so much for your time, and I'll see you in the next video. Peace.